Hey everyone, welcome back to Corporate Decoder, the place where we crack open the tough financial documents so you don't have to. Today we are looking at Live Nation Entertainment Incorporated, and let's just say they have been busy behind the scenes making some big moves with their credit agreements. So what exactly is this filing all about? Well, on the 21st of October 2025, Live Nation, the company behind Ticketmaster and a whole lot of concerts and festivals, entered into a new credit agreement. Think of it like renegotiating the terms of a giant loan or even getting a whole new set of loans to manage their ongoing business. It is a pretty important signal about how they plan to fund their operations and future growth. This new deal replaces their old credit agreement and basically sets them up with a much larger and more flexible way to borrow money. It sounds a bit technical, but what it means is they have access to significant funds to keep the music playing. Literally, they have arranged for what they call new senior secured credit facilities. This is essentially a package deal of different types of loans. We are talking about a massive $1.3 billion multi-currency revolving credit facility, which is like a flexible credit line they can draw from as needed for different currencies. Then there is another $400 million venue expansion revolving credit facility, specifically for developing new venues. On top of that, they have a $700 million delayed draw term loan facility, meaning they can draw this money over time, and a $1.3 billion term Loan B facility that was actually fully drawn on the day they finalized the agreement. We are looking at a substantial amount of borrowing power. The money from the $1.3 billion term Loan B facility was primarily used to pay off their old loans. Any leftover cash can be used for day-to-day operations, general business purposes, or other approved ventures. For the revolving facilities and the delayed draw loan, the funds can be used for the same things, plus. Importantly, for the venue expansion facility for building new venues, this tells us Live Nation is not just maintaining its current operations, but actively looking at expanding its physical footprint. Let's talk about when these loans are due. The commitments for that term loan facility expire in October 2027, meaning they need to decide by then if they want to draw that money or not. The revolving facilities in that term loan facility mature in October 2030. However, there is a catch. If certain senior notes from 2027 are still outstanding past a certain point, and their cash on hand isn't enough to cover those notes plus an additional amount, then these loans could become due much sooner, aligning with the maturity of those notes. The big term Loan B facility, the one they borrowed fully immediately, matures later in October 2032. This structure gives them flexibility but also introduces some potential complexities down the line, depending on their financial health and other debt obligations. Now for the interesting part, how much does this all cost them? For the term Loan B, it is going to be paying interest based on something called Term SOFR, which is a specific benchmark rate plus an additional 2.00%, or they can choose an adjusted base rate plus 1.00%. For the revolving facilities and the term Loan A, the interest rates are a bit lower. Term SOFR plus 1.50% or the base rate plus 0.50%, with the possibility of those percentages dropping if their leverage ratio improves. They also have to pay a fee of 0.35% per year on any portion of the revolving credit lines that they don't use. This is a pretty standard way for banks to ensure they are compensated, even if the borrower doesn't tap into the full loan amount. They also have to start making payments on these loans for the term Loan A. Payments begin either when all commitments are used up or by October 2027, with quarterly payments starting at 0.625% of the original loan amount and increasing to 1.25% after 3 years. The term Loan B has smaller, quarterly payments of 0.25% of the original amount. On top of these regular payments, Live Nation is required to make extra payments or prepayments from excess cash flow, or from money they get from selling assets, taking on new debt, or other specific events. This is to help reduce the overall debt load more quickly. To secure these loans, Live Nation and some of its subsidiaries are essentially putting up most of their assets as collateral. This includes almost all of their tangible and intangible personal property. They are also pledging shares of their domestic subsidiaries and 65% of the stock of their first-tier foreign subsidiaries. This is a significant commitment showing how serious they are about securing this substantial financing. Now, here is a critical point for anyone watching their financial health. The agreement includes a financial covenant. This is a rule they have to follow to avoid technically defaulting on their loans. They must keep their net debt, which is their total debt minus their cash, at a certain level compared to their earnings before interest, taxes, depreciation, and amortization or EBITDA. Right now, this ratio needs to be between 6.75 times and 5.25 times their EBITDA, with the first measurement happening after the first quarter of 2026. This ratio is set to decrease over time, meaning they will need to reduce their debt relative to their earnings each year. If they fail to meet this, it could trigger major problems with their lenders. Beyond that big financial rule, there are a host of other restrictions or covenants in this agreement. These are designed to protect the lenders. Live Nation and its subsidiaries are restricted from doing many things without the lender's approval. This includes taking on more debt, paying out dividends or making other cash distributions to shareholders, making significant investments or acquisitions, paying off certain existing debts early, putting up more collateral for other loans, making special deals with affiliated companies, selling off major assets, or merging with or acquiring other companies. If they break any of these rules, the entire loan amount could become due immediately. This agreement is a pretty big deal for Live Nation, and it gives us a lot of insight into their financial strategy for the next several years. It's all about securing the capital they need to operate and grow, but it comes with strict conditions. This document essentially formalizes Live Nation's commitment to these new loans. It is the official notification that they have entered into these new financial obligations, which are detailed in the previous section. And finally, the filing includes exhibit information, mainly pointing to the full credit agreement details that will be available in their annual report. It also flags the interactive data file, which we can use to dig even deeper if needed. So what is the big picture here for Live Nation Entertainment Incorporated? This move to a significantly larger and more complex credit facility signals a company that is betting on future growth. They are securing the funds necessary to develop new venues, which is a tangible investment in their long-term strategy. The expanded borrowing capacity also provides a cushion for general corporate purposes, suggesting they anticipate needing capital for operations, potential acquisitions, or other strategic initiatives. However, it is not all smooth sailing. The introduction of stricter covenants and a leverage ratio requirement means the company needs to be very strategic and disciplined in its financial management. Failing to navigate these conditions could have severe consequences, including making all their debt immediately due. This is a serious risk that investors and management will need to monitor closely. The fact that they immediately drew the full $1.3 billion term loan B facility indicates they might be proactively using this capital, perhaps to set themselves up for future expansion or to refinance existing more expensive debt. Looking at this from a Warren Buffett perspective, we see a company actively seeking growth through real asset investment in venues and securing the financial backbone for it. But like any leveraged company, the key will be their ability to consistently generate enough earnings to service this debt and meet those covenant requirements. The entertainment industry can be cyclical, so their ability to maintain strong EBITDA even during slower periods will be crucial. My take is that Live Nation is taking a bold step, which is often necessary for growth. They are leveraging their position in the market to secure substantial funding. The critical factors to watch will be how effectively they deploy this capital, particularly for venue expansion, and their ability to manage their debt and meet those demanding financial covenants. The risks are real, but so are the opportunities this new financial structure presents. Alright, that is our breakdown of Live Nation's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.